excited about having two partners from Vitruvian, about having Peter and Tom here. Before starting, I just wanted to have a sense, a show of hands for who are the entrepreneurs that we have here in the audience? Okay, who are the investors that we have here in the audience? Okay, who are those that didn't know what to do and they showed up for the fun? Okay, a few of them. Okay, who are the entrepreneurs that have raised more than 3 million already? Okay, there's one over there, and there's another one here. That's good. Maybe those are some of your targets.
Yeah.
Excellent. So, guys, thanks for having, thanks for coming over. I think it would be great if you could start by introducing a bit, I mean, your backgrounds and particularly right now what Vitruvian is doing. I mean, I have known Peter for a few years. You started doing a lot of seed angel investment. Now you're doing a lot of growth. So if you could position yourself so that the audience can capture what's your investment focus right now, would be excellent.
Sure. So, but a little bit of background to start. So, been an angel investor in the US and Europe for about 15 years. Ended up doing about 110 angel investments, just very, very small, but alongside some of the top VCs in Europe and in the US. And then met the Vitruvian guys actually about 8 years ago and got involved just as a part-time special partner and worked actually at that time in our first fund, which was a 925 million euro fund. Worked with Tom on Just Eat, which we can come back and talk about later if you like. And then I was a part-time special partner for the second fund, and actually on that one worked with Tom again on Farfetch, and again we can talk about that later. And then joined full-time for Fund 3, which we've just raised, which is a 2.4 billion euro fund. And for all three of these funds, we've done, I think roughly half of our deals are minority growth equity deals, and roughly half of them are majority buyout deals by number. There are more euros or dollars in the buyout business, obviously, those are bigger deals, but we like doing both. And the smallest check we have ever written is 25 million. So that, that probably puts and that would be true going forward as well. So that would be the minimum check. The upper scale would be something like 250.
Excellent. So then, Peter has just mentioned a few interesting names. Just Eat, okay, Farfetch. I could also mention Skyscanner. Okay, so those are $3 billion companies, just kind of sort of in 1 minute. Okay, that's very good. So please, could you? I mean, you guys are saying that you are doing sort of checks of 25 million and so forth. Could you actually tell us a bit, I mean, how are you positioning yourself in the investment life cycle of technology? I mean, a number of people here, as you have seen, they are now at the seed level, okay? And here in Barcelona, we are very happy when we see growth, people, guys like you. Could you tell us a bit, I mean, for the usual company, okay? How does it work, and when you guys sort of get involved, and when they should start knocking on your door? Let me put it like that.
I think on the minority side, generally the companies that we've invested in have already received seed funding, Series A, Series B, and then at Series C, Series D, then the investment size and the scale of the business is generally, becomes big enough for us to deploy 25 million pounds. So generally, in a sort of, generally the business would be seeing 10, 15 million somethings of net revenue.
Okay.
Not GMV, but net revenue, so commissions basically. If we're talking about an online marketplace, for example, probably has 100 employees or more. Those are really sort of the metrics at which we sort of really get started.
and the business may not be profitable overall at the stage at which we invest, but we would look down at the unit economic profitability, and we would expect to see either single visit or single user economics that are beginning to look quite attractive, even if the overall company, is not profitable. Neither Just Eat nor Farfetch were profitable when we invested.
Excellent. How many people here have companies with over 50 employees? Okay, 1, 2,
Yeah.
and over 100? Okay,
Yeah.
the 50 ones will be the hundreds of the future. You know that, no? So then, how could you tell us a bit more? I mean, with those companies, when you get involved with for instance, a Just Eat. I mean, what is important to understand also for entrepreneurs is, I mean, apart from the money, what do you guys bring to the table? I mean, how do you guys analyze the company? And what value do you guys bring to the table? And what can they expect beyond your involvement?
So shall I talk about the sort of process? Maybe
Yes.
Peter talks about the value add. The difference between a Series C or Series D round rather than a seed round is there's actually quite a lot of data, right? You can do quite a lot of analysis to figure out what's really, really going on. And so, whereas a seed fund will be backing an idea and a really sort of credible founder and a small team, we really can not just back a team, but also back the unit economics and back a big market and lots of potential. The fact we do a lot of work is, and so we'll bring in accountants, we'll probably bring in consultants to do some interviews of customers or suppliers to really understand what's really, really going on. And that's really helpful, I think, for two ways. Reason number one is we bring insight. Actually, it's generally the first time these companies have had somebody really look at the company from a very analytical perspective and say what they could be doing differently. And I think the second thing is that we generally, therefore, get a lot of conviction. So we can for example, for Farfetch, we invested in the Series D, and then we followed our money in the Series E and the Series F. And that's a really important thing for an entrepreneur to be able to go back to the same investors to help them with their next fundraise.
Just one point. It's important here to notice it's A, B, C, D, F, and it continues. No, it goes beyond that. So guys, I mean, the ones that are looking at the A is just the first step.
It's true. I just wanted to add what Tom was saying about, to respond to your question around, beyond just the money, what should you expect from a later stage investor? So I think Tom was saying, one of the first things we've done with all of our portfolio companies is help with M&A. So very often we're investing in, Just Eat is a good example, and then we help them with two things right from the get-go. One was M&A, so buying, competitors or alternatives in different territories where they didn't have a position or they had a weaker position and they wanted to buy their way up. That's the first thing. And the second was sort of international market entry, and that can sometimes be build entry rather than buy entry. So we do both of those. But then over the last 2 years, we've actually built quite a big team at Vitruvian, who we call our value-added team. And we've got specialists in technology, in digital marketing, in recruitment. Actually, recruitment always ends up being, hiring great people is, the big challenge. So that's the one we probably spend most time on. Operations, nearshoring, I think those are, so we realize these days that you have to turn up beyond just the check, turn up and try to be helpful.
Excellent, that's great. So what's your view when you look at Europe versus US in terms of exits? Because you guys are working hard, 12, 14, 16 hours a day, because at some point in time you want to see an exit, okay? And you guys are certainly closer than I am as a seed investor to the exits, okay? So how is your view on basically, for instance, European exits? Here in Barcelona, actually, we have had our first share of recent exits, like Privalia, like Social Point, okay, a couple of companies in which I was actually involved. And and also beyond that, Spain has seen 1.5 billion of tech exits over the last 3 years. Okay, so how do you see that the landscape for exits, I would say, across Europe, and particularly, I would say, Spain is changing vis-a-vis what you may have seen in San Francisco or in the US?
Do you want to talk about Europe? I'll talk about the US.
Yeah. No, I think we have a relatively healthy and improving exit environment. I think that corporates understand, and particularly sort of old world corporates, I think I begin to understand that digital and online are critical, and that they need to tool up in these areas, and it can often be better to acquire than actually build internally for cultural reasons. I would say also that 5 years ago, the public markets were very, very weak for tech companies. You'd have investors looking at IPOs and saying, I can only pay this multiple of EBITDA or this multiple of earnings. And I think that now in certain sectors, we're beginning to see some real success stories. Just Eat was a real success story, and that allowed Takeaway in Netherlands to go public, Delivery Hero in Berlin to go public. I think that the public markets investors understand the power of online marketplaces in a way they didn't 5 years ago. Auto Trader in the UK, Rightmove in the UK, Zoopla, these are all very powerful. These are all very powerful businesses that are well rated. So I think that it's an improving exit environment, and we should all feel good about that.
And have you seen European corporates also sort of looking into buying more and more startups, for instance?
Absolutely, I think that's absolutely right. I mean, I can give you many examples of old world businesses. Take Accor, for example. Bought One Fine Stay, which is a sort of Airbnb for very high-end properties. Kind of adjacent, but also pretty different. And it's pretty interesting that these guys put their hand in their pocket for 150 million pounds to say, actually, I want this to be part of the Accor family.
Excellent.
And I just want to get back to your to the US point, because I think being a later stage technology investor with a center of gravity in Europe, we're very excited about what's happening in Europe, and actually, by the way, that's why we're here. And at the same time, we recognize that a lot of entrepreneurs, probably some in this room, will at some point want to expand their business into the US, because for a whole bunch of historical reasons, the US has a very active trade exit market, strategic exit market, especially with potential acquirers like Facebook, Amazon, Google, Netflix, the big obvious ones, and a thriving technology IPO market as well, which seems to be coming back this year. And so what we've done at Vitruvian is we've opened an office in San Francisco, which does two things. One, it helps Europeans, like hopefully people in this room in a few years' time, helps you land in the US. And we would aim to help you drive your revenues in the US, or maybe make acquisitions in the US, or maybe get acquired in the US by Facebook or Apple or Google. And at the same time, we are also looking for US investments, but only US investments that have a strong European angle, where they may be a US team who've built a great product in the US and started to build the business in the US, but we can help them land in Europe, and as we all know, living in Europe, Europe is in many ways much more complicated than the US, and therefore we would like to be a good European partner to both the US entrepreneurs and the US investors.
Excellent. So just coming back to Barcelona, coming back to here, I mean, you guys, I'm sure that you have seen sort of the ecosystem evolving. You have seen even potentially even due diligence. I mean, a number of companies coming out from Barcelona, from Spain. What's your view? But I understand that you have not yet sort of completed an investment here. I mean, what's your view here? What are your expectations with regards to the ecosystem that you're going to find here? and even what would be some of the recommendations for some of the entrepreneurs that are here in this room that are thinking, hey, at some point in time I'm going to need 25 or more, okay, and maybe I will be knocking on your door. So just if you can tell us what you have seen in sort of the ecosystem evolving, and maybe some recommendations for the people here.
Yeah.
Well, so we haven't made an investment in Barcelona. We are investors in a Spanish company called inebrary, which provides financial services to SMEs, particularly around FX. That business was set up by two Spanish founders living in London,
Yes.
but had a tech team in Malaga. Actually, it's now dual headquartered between London and Madrid. And I think one of the things that we found is what fantastic talent there is in Spain. Malaga is a fantastic location for a tech team, very high quality people coming out of universities. Madrid, we have an amazing data science team. And that fills me with a lot of confidence when I come to Barcelona. It's my first time here professionally about what we might find here.
So I would totally echo that. So when we're looking at an ecosystem, as we have been doing over the last few years, based in London, but then you start to see Berlin happening, you start to see Stockholm most definitely happening. I think we could definitely say the same about Paris these days, is a combination of two things often. One is the talent, and for us that's especially the technical talent. And when we look around Barcelona, there are at least two very, very strong technical, I guess we're sitting in one, right?
Mm-hmm.
Two very, very strong technical institutions. And that is always, at the heart of all of this, that's the most important thing. I read there was a survey that amongst Barcelona graduates, that 30% of them list becoming an entrepreneur as, what they want to do when they leave uni. So that's beginning to change. We've seen that time and time and time again, and that's a really healthy indicator. And then the second is the availability of capital. And as Oriol said, that we've often observed that there's a lot of early stage seed capital here, both the angel and institutional seed. And then between seed and us are the A, B round guys, and we are very excited to see friends of ours, Axel, Atomico, North Zone, very, very, these are top-tier, global top-tier firms making investments here in the A and B rounds. And, that's just going to make it much, much easier for us to start to get the pattern recognition we would normally see by the time we're looking at the C or the D or beyond, as Oriol said.
Excellent. And have you, because the other day it was an event and people asked me, okay, should I always raise sort of 5, 10 million before actually sort of raising 25 and before actually exiting? I mean, have you seen sort of capital efficient companies that can get to, let's say, 20, 30 million technology companies, and then sort of almost pre-exit, you come in maybe 18 months before exit, and then just kind of sort of do the exit? In terms of, there's people here and outside that have been working on their companies for quite a long time, and via virality, via SEO, they may have had the chance to build significant businesses. Is that something that you guys are also looking into?
Sure. Yeah. I think that's absolutely. I think we're sort of fairly agnostic in terms of capital structure. We've invested into businesses where founders own 90% of the business and where founders own 20% of the business. It doesn't really matter. We're just trying to help and support these businesses any way we can. And for founders that have an eye on the exit in 2-3 years' time, but want a professional money guy to sort of help, not just with the exit, but also professionalization and bringing in a C-suite of executives. Perfectly smart thing to do.
Excellent. And just a few last questions. Were there a few patterns on your successful companies that you can tell to our audience? I mean, in terms of saying, hey, listen, a successful company has usually these 3 characteristics. I don't know, team, international, growth product. Can you maybe just summarize so that people know, I mean, what's my roadmap going forward?
Yeah, no. So, I mean, first of all, it is always about the quality of the management team. And the old thing about you take an A team with a C idea any day over the other way round, right? And so it's always about the quality of the management team to start. And then second, at Vitruvian, we like asset-light businesses. So, the marketplace businesses, Just Eat and Farfetch, for example, Skyscanner to a certain extent, are these very, very clever asset-light, inventory-less or inventory-low businesses, and those perform very well. And then if you read our website, you'll see all over it, we look for dynamic situations. And what that really means is growth, and that really means sort of revenue growth, real revenue growth. And that's often driven by technology disruptions, sometimes by regulatory disruption as well. But for most of us, most of the time, it would be rapid growth driven by technology, innovation, and disruption.
And I guess that international, it's a must across all your companies.
Yeah.
Or
I mean, it's not a must, but I think with these asset-light business models, as Peter says, you would generally ask the question, why aren't you international? I think there's been a massive change in the last 10 years about the ability for software businesses to scale internationally with very low capital needs. So that's an extraordinary change in the technology landscape for the last 10 years.
Excellent. So really, thanks a lot. A huge round of applause for our guests. And it's been great. Thank you.
Thank you.